Module 6, Risk, Mistakes and Capital Preservation. Protect what you have before chasing what you want. Most investors focus on returns. Great investors focus on survival. Avoiding permanent loss is the foundation of wealth. Module Outcome. By the end of this module, students will understand Buffett's famous rule number 1, don't lose money. Differentiate between permanent loss of capital and short-term volatility. Learn when to diversify versus concentrate. Extract lessons from famous investing mistakes. Core transformation. Students stop taking reckless risks and start protecting capital like professional investors. Lesson 1, Rule number 1, don't lose money, what it really means. Key insight. Buffett's rule number 1 isn't just a catchy phrase, it's the foundation of wealth preservation. Focus first on avoiding permanent losses. Profit comes naturally after protection is in place. Practical interpretation. Think like an owner, would you accept losing this business? Avoid trades or purchases driven by emotion, hype, or speculation. Reflection exercise. Write down 3 past financial decisions where losses were preventable. How could a "don't lose money" mindset have changed the outcome? Lesson 2, Permanent loss versus volatility. Understanding the difference. 1. Volatility, normal ups and downs in price. O temporary and recoverable. O does not destroy capital if held long-term. 2. Permanent loss, losing principal or investing in a flawed business. O hard to recover. O often caused by poor judgment or lack of discipline. Key insight. Long-term investors embrace volatility but avoid permanent losses at all costs. Student exercise. Think of an example. Which investment caused volatility only? Which resulted in permanent loss? How could permanent loss have been avoided? Lesson 3, Diversification versus concentration. The balance. Diversification protects against mistakes. Concentration rewards deep knowledge of businesses you understand. Buffett and Munger approach. Own a few businesses you deeply understand. Avoid spreading yourself too thin. Diversify enough to protect against catastrophic loss. Practical guidelines. Beginners, start with broad diversification, index funds or ETFs. Advanced investors, concentrate within your circle of competence. Student exercise. List 3 to 5 investments you fully understand. List investments you should avoid. Decide how to balance concentration and diversification safely. Lesson 4, Learning from famous mistakes. Famous mistakes to study. 1. Long-term overleverage, investors borrowing too much and losing everything. 2. Ignoring fundamentals, chasing hype like .com or cryptocurrency bubbles. 3. Speculation disguised as investing, buying without understanding the business. Key takeaway. Studying mistakes is cheaper than making them yourself. Mistakes are teaching moments if you analyze them calmly. Reflection exercise. Pick one famous investment failure, e.g., .com bust. What mistake caused it? How could a focus on capital preservation have helped? Module summary. Key takeaways. Rule number 1, don't lose money, focus on protection first. Permanent loss is the enemy, volatility is normal. Diversification protects, concentration rewards knowledge. Learning from mistakes is crucial to avoid repeating them. A disciplined approach preserves capital for compounding over decades. Module assignment. Protect your capital, exercise. Answer in writing. 1. Identify one area where you are currently taking unnecessary risk. 2. How can you reduce exposure without missing opportunities? 3. List 3 lessons from historical investing mistakes that apply to you. Module completion statement. Protecting capital is more important than chasing quick gains. Wealth grows quietly when losses are avoided.